Hello, everyone, and welcome to another episode of the What the Finance podcast, where we talk to experts to try and figure out what is happening in the markets. And today, I'm happy to be hosting Tavi Costa, who's an expert in the commodity markets and currently a portfolio manager at Crescat Capital. So, Tavi, thanks for joining the podcast. And I guess, can you tell us a bit more about maybe your career and how did you get into commodities?
Oh boy. Well, first, thanks for having me, Anthony. And how did I get here? I guess a little bit by accident, but also I guess it's been a learning curve, not only from a professional perspective, but also through a learning curve when it comes to my passion really was. I never, thought I would be a global macro investor, but I guess things just kind of fell through into what I thought I should be doing. And, been always very culturally diverse and had a lot of experience with dynamically living in a business environment with my parents that always owned their own businesses. And I've always been fascinated by markets and fascinated by the economy, and really decided to start learning about it when I at an early age. And after college, even though during college, I spent most of my time reading a lot of newspapers and reading a lot of different books about macro investing without even knowing what macro investing really was. After, my professional career started, I started working with Kevin, which became my mentor. Kevin is my partner now at Crescat Capital, and we both manage here the portfolio. And we started to really focusing on, Kevin is more, a quantitative and analytical person. And I learned certainly from his principles over the years, but I've been adding to the table when it comes to the macro side. So I use the same ideas and methodology of creating quant models in the fundamental equity side to now macro, and it really evolved the process of the whole business at Crescat. So recently, I would say in 2018, we decided to start a whole fund that would invest in precious metals, and that was really when we began to feel more comfortable about commodities. When we started calculating the imbalances when it comes to capex, for commodity producers being so historically low for different reasons. And most of them, now not only political, but really because of extreme conservatism after years of a downward movement when it comes to asset prices, and some of those being in a real recession and depression, depending on the industry in commodities. And we never thought we were going to have a pandemic. We thought that usually those big trends are triggered by different factors. And we saw the pandemic coming in, big shock economically. Immediately, we had this huge fiscal and monetary stimulus in order to restore the economy. That really changed our views about inflation after reading about the 1919 Spanish flu and other times in history when we had similar developments in the markets. And so fiscal stimulus driving inflation changed our views, and it started to really accumulate inflationary assets, and commodities were certainly a big part of that pack. And so a lot to unpack here, but it's basically how I got into commodities and started to dive into what are the best ways to invest in the commodities markets. And so there are a lot of different ways that we express that view, one of them being an exploration assets. We're happy to dive into any of those topics.
Yeah, definitely. Well, I guess you could say commodities have been very unloved over the past, 10, maybe just until the last year or so. So I guess
Yeah.
what did you see in 2018? You mentioned there, these miners and stuff haven't been doing much capital expenditure, so not much exploring, so potentially shortages in these, commodities. Was there anything else that you really saw that's been solidified over the past few years?
Yeah, I was very I would say I was very skeptical about cyclical commodities such as copper and oil at the time, but I was still starting to come along when it comes to monetary metals, mostly because of the yield curve inversion problem. In 2019, we've had about 75% of the yield curve inverted in the US, and we had yield curve inversions happening across the globe. That really changed my opinion about what was likely ahead for gold and silver. And that is because of our empirical analysis on how assets tend to perform after those levels of inversions. And just to explain, while a lot of people like to look at 2 versus 10s yield spreads, or 3 months versus 10-year yields and so forth, for me, and it was a great idea, I think, at the time, was to create a much more comprehensive model of looking at all possible spreads of the yield curve, which I can claim that was me who invented, because I don't think anybody else had it invented before. And it's looking just at the percentage of the yield curve, percentage of yield spreads that are inverted. And after looking back all the way to the 70s, on all sorts of yields that became available over the years, what you find is that every time we reach that 75% handle on percentage of inversions, those are times when you see immediately a recession follower, a major economically downturn that is also accompanied by a bear market, but also accompanied by a rise in gold prices. So not all of them actually, but what you see is that gold to S&P 500 ratio rises significantly. And so we certainly saw that, and maybe some people will call it, it was just the pandemic, but that was an indicator that didn't fail again. And we didn't see this indicator actually reaching extreme levels like we saw back in 2019 today, but that was what gave me the conviction to start thinking about gold and silver first and foremost. And then when the pandemic hit and we start seeing the unleash of fiscal stimulus and monetary stimulus, I think I immediately start having this thesis about other commodities, and agricultural commodities being one of them, base metals for other reasons such as the Green Revolution and electrification trends globally. And I guess that sort of changed my mind about the whole spectrum of commodities. And one thing I should add is that the commodities to equity ratio was certainly a big indicator to me to start at least considering investing in commodities. And the reason for that is commodities to equity ratio today are near 50-year low. They have been for many years. And usually that tends to not only mark the beginning of a bull market or a cycle for commodities, but also a time when commodities tend to outperform equity markets. It doesn't mean one needs to decline and the other needs to rise. It just means one is likely to outperform the other. So as a portfolio manager, the goal here is to really look for the different ways to express the two sides of that trade, hopefully in a very asymmetric manner of looking to not only short the equity market, the most overvalued things, but also find the most undervalued parts of the commodities market.
Yeah, it's really interesting. And I guess one thing that we've probably you've heard it a lot, and most people have been hearing, is it's like a commodity super cycle. So I guess what are the indicators that you're looking at and keeping a real close eye on to see what if they change or if something happens that you're more you have more conviction on your current play?
I think my issue is not conviction. I guess I've got the conviction is I'm mostly worried about the other side of it, or where I could lose conviction. I think there are some indicators that I'm paying very close attention to, which one of them is the productivity in the global economy. If we start seeing the global economy improve its productivity relative to, in particular, I would say growth, units of growth relative to units of debt, meaning we're going to need, if we start seeing a trend where we're using less debt to generate growth, then I think that's a change in my view. That's certainly not what we're seeing today. We're seeing more units of debt to generate less units of growth, and therefore debt to GDP continues to grow in an environment where we have, I would say, incredibly constrained supply, given the fact that capex and capital spending cycles of commodity producers continues to be very low, not high. And the other part of it has been the wages and salaries growth, which we haven't seen in many, many decades. That's a structural change. The reckless fiscal spending that is happening today, I think it's another thing to add. You have this very extensive fiscal agenda, from infrastructure development play to peak inequality to the geopolitical environment that also requires more defense spending in different parts, and even the Green Revolution will drive fiscal spending as well. The fourth thing that is important is the deglobalization trends. If I start seeing a reversal of those trends, certainly I will change my view. I think we're at the beginning of those trends right now, and I think we'll see that persist for much, much longer than just a few years. And so all those are playing together into this inflationary environment, maybe a new macro regime that we haven't seen in many decades, that we've seen in the 70s, in the 40s, in the 1910s, maybe in a different way today, because we have a trifecta of macro imbalances. We have the debt to GDP problem of the 40s, we have the inflation problem of the 70s, and then the speculative environment of the 90s and the 1929 and late 20s type of the speculative environment. And so those become very large political constraints to policymakers when it comes to fighting inflation. So those are the things that I think are driving my views about why I think commodities will continue to outperform. And it's not going to be a straight line up. It's going to be a lot of ups and downs like we've seen now. And it's time to be accumulating assets and buying the dip, in my opinion, when you see those times.
Yeah, it's really interesting. So basically what you're suggesting is, you say that there's less growth for the amount of money being spent. So are you seeing like a period where we might see some stagflation potentially, where we have inflation with not as much growth really?
I think it's a possibility. I don't need to be right necessarily on that, but I think there's a very large possibility that some periods of stagflation in the next decade would be a big part of it. And then, but certainly, inflation is cyclical as well. Like in the 70s, we've had 3 waves of inflation during the entire decade, even starting a little before the 70s in the mid 60s. And those 3 waves, the big part of it was they got progressively higher. So we saw higher highs in CPI, for instance, just a way of gauging that. And today, I think we're going to see something similar. I don't know if cyclically we're at peak right now of inflation. And I don't think I need to necessarily answer that question. But I think that it's the more and the longer inflation stays in the system, it will infiltrate the economy in different ways and change psychologically the way the consumer behaves. And I think policymakers are far away from realizing those changes. And by that, I mean, back in the 70s, if you read any literature at the time and any financial history of the time, it was very well known, the perception of how fiscal stimulus would drive inflation. And today it's quite the opposite. I don't think we have that today. That notion is not there. So that is why we're seeing the current deficit, or the twin deficits that we have, including current account and also the trade balance, are both as low relative to GDP, or I should say as high relative to GDP of a deficit as it was at the worst times of the global financial crisis. And I don't think we have seen much of it yet, because defense spending is at a historical low that might rise with deglobalization trends and so forth. And so, we start thinking about those different ways of adding to the fiscal problem, and that I think will continue to drive inflation much further. So a lot of ramifications from this, but it's those are all big long-term issues that might set up different, I would say, a different macro and market environment with different leaderships and different factors that will work. I'm very concerned about earnings. I'm very concerned about, like I would say, a factor that has worked very well in the markets recently has been valuations. Companies that have extreme valuations got creamed. So if you look at most of the companies that have very high enterprise value relative to sales, or any company that doesn't provide a lot of profitability today, those companies relative to how much they're valuing value in the markets, they really got re-rated in prices. And so some of those companies are down 40-50% today. The next wave of this is going to be, in my opinion, the companies that are been driven by their profitability and very stable earnings, which I think are unsustainable in an environment where you have wages and salaries growing, material prices rising, cost of capital rising. And so that's going to squeeze margins. So I'm paying attention to businesses that may fall into that category and be impacted by that.
Yeah, it's really interesting. I was actually just on Twitter before, and I saw this post, and it was saying how, maybe some of the more traditionally defensive stocks, they're at sort of really high valuations at the moment. I think Walmart, Costco, Kraft, they're almost at 40 times PE ratio, which is crazy to think. So we've almost seen that complete swap to these companies. Do you think those companies could see a similar maybe downtrend if they do start missing earnings, or if they start struggling with inflation?
I want to make a distinction of defensive, because there's defensive stocks that you mean by stocks with a lower beta to equity markets, and that's a fine description. And I agree that there are some of them with margins that may be impacted by this new environment we're entering. However, I do think there are major opportunities in actual defensive stocks that will be benefited by military spending in the US. I think throughout history, just to elaborate a little further on that, throughout history, we've seen a declining trend in the military spending relative to GDP, now at about 3.3%. And back in the 60s, for instance, it was somewhere close to 9% of GDP. So in the 40s, it was much higher, by the way. It was 30-40% of GDP. So I think we can see, it's plausible to see we're at 3.3% today, just double from here. Let's just call it 6.6%. If that's the case, we're going to unleash somewhere close to $1 to $1.5 trillion of spending, of military spending, of defense spending by the government into these industries. The majority of that money goes into the companies that are part of these industries in general. And the revenues, the defense companies today in the US are generating somewhere close to $250 billion of revenue. So you're talking potentially spending could be 4 times, or even 5 times or 6 times the size, conservatively, the size of the revenues being generated today. That's not including NATO countries that may also increase their defense spending, that could potentially drive even further revenues to those companies, because none of those NATO countries, the majority of them, don't have that industry as well developed as the US. So most of those countries will be importing or from the US. So we have to think about that, because that's going to create some big opportunities for getting long those defense companies. That's why I wanted to make that distinction. Now, the other side of it, which is the ones you're referring to with the low beta relative to S&P 500, I think that those are certainly opportunities to be short. Some of them that could be falling into the category, maybe Coca-Cola could be one of those as well. We like to use a model. We use a quant model to really pick and choose from the model what are companies that we think that score well currently that may actually fall in the score because of those high quality earnings that they have and high margins that they have. So what are potentially companies that will be scoring bad in the future if they're going to be disappointing on those in those metrics in the future? So that's something we've been working very hard to find those industries that maybe fall into those categories.
Yeah, and you mentioned defense there, and we've just seen today Iran and China, they've sort of done a military pact as well. So you could see further spending potentially by Saudi Arabia in the Middle East and other countries, Turkey. So I guess, as you said, there's almost becoming this divide, and there's going to be, they've been underinvesting for so long that they're going to have to ramp it up, and that's, good for commodities in the long term.
Yeah, there's another theme that will play out on this as well. The deglobalization trends is going to create a non-residential construction spending that we haven't seen in many years in the U.S., in many decades, I should say. And it's important to note that most of the commodities have been driven, the commodities bull market that we've seen so far have been driven by supply constraints. So nothing has been really related to the demand side. Now, what if we do see construction spending actually increasing in the US? And what do we see as far as new demand, a wave of demand coming from those new trends? I think that that's a possibility. Deglobalization trends might actually drive developed economies to start really reshaping their infrastructure when it comes to manufacturing plants. I don't think we're going to be importing from China as much as we do today in the next 5 to 10 years. And if that's the case, how is the world going to look like when it comes to those revamped infrastructure developments, especially in the US and other developed economies? And who are the companies, commodities, and businesses that will really benefit from those changes in the future? Engineering companies, construction companies, other commodities, cement businesses, steel producers, the list is long. And will the government play a role into facilitating those shifts from China manufacturing plants to the US, and the changes in the companies that will be really hurt during the process of changing that? Let's call it Apple. Now, would Apple be as successful and have the margins they have today if they're not operating in China to the same degree that they have been in the last 5 to 10 years? I don't think so. I think they're going to get hurt. I don't think their profitability will look the same in the future. And so we have to think about those companies and how the reshaping of the geopolitical environment will hurt those businesses. The geopolitical environment will set up other changes, such as even the quality of international reserves. Now, we've seen the trends now of folks selling U.S. treasuries to now maybe buying other tangible assets to improve the credibility of their fiat currency. So there are other themes happening, almost lockstep with this changes in infrastructure and changes in defense spending and so forth. I call it a plethora of new macro trends that we're seeing right now that we haven't seen before. And so it's very exciting because there are a lot of different ways of making money in this market.
Yeah, and I guess, you mentioned a few potential industries that will benefit. You could even go further and maybe say, AI companies that are helping in manufacturing. You could even, and I think that's the thing, it's finding those specific companies where you can take advantage of these trends. And as you've mentioned it throughout the whole time, there's so many trends that are happening all at the same time. And that's really where your thesis comes from. And I know you've mentioned previously, precious metals. And I think you prioritize silver, if I'm correct. I'm not sure if you can explain that, or you think that might be the best performing asset.
Well, it's
I think
it's one of the cheapest. No, I think it's one of the cheapest metals. I am always chasing silver related assets. It's always has always been the case. I'm always chasing what I think it's cheap. And today you can find developers that will be producing mines in the near future, that would probably be producing or generating for cash flow to a degree where the prices today are trading at 2 or maybe 1 time annual free cash flow in the future, or expected free cash flow, in a very conservative calculations of being wrong completely on capex to build the infrastructure for mining those deposits. I think that it's insane to what we're finding today in that part. Exploration assets is what really excites me, because I think that the producers are getting really excited about the increasing prices of commodities, and they're really depleting their reserves that they have of natural resources and not replenishing them with new ones. And so we're seeing conservatism when it comes to capital spending, and with that, we're seeing exploration budgets being in a declining trend for many, many years, causing number of discoveries on natural resources to decrease drastically. So I believe we're going to enter an exploration age of commodities, particularly gold, silver, copper, base metals, battery metals, and so forth. And so who is going to be driving those changes when you're at a time when you don't have the necessary labor and professionals that can drive those changes in the future? And as a company, we decided to start funding those opportunities that we think will be the next high quality exploration assets of the next 3 to 5 years. And we want to be part of that discovery curve that we think are going to be increasing, meaning we're going to see new discoveries, and hopefully in a much more productive way when it comes to how much money is spent in the ground in order to find those deposits, and being extremely successful at finding those over time. And so the reason that allows us to have the conviction to go into that part of the industry, which is extremely risky, because it's not just the metal price that you have to be worried about, but the risk of successfully exploring those assets. And in our opinion, it's hard to think about a world where gold and silver and maybe even copper, but really gold and silver will be lower than today in 5 years from now. And so if you believe in that, just looking at CapEx trends, the monetary disorder, the fiscal stimulus that we're seeing, the inflation trends, the debt problem, a likelihood of a yield curve control in the future if nominal yields continue to rise in the US. I mean, there's so many reasons to believe that gold should be higher, not lower in 5 years from now, not tomorrow, not next week, not next month. And if you have that idea, that thesis in your mind, it really eliminates a little bit of the risk of the metal price. Obviously, that's driven by our research and conviction, not by certainty. And then you can then really work towards looking for the best assets and focusing on businesses that can actually have very high quality technical teams that can deliver on the exploration side. So that has been most of my focus in most parts of my days, meeting with CEOs and technical teams that can actually deliver on that side, working with Quinton Henney, which is a geologist, one of the smartest geologists in the industry. And so it's been very interesting to be part of that new secular trend, in my opinion.
Yeah, I can imagine. And are you mainly focusing on companies in the US, or do you sort of have a scope for worldwide?
Worldwide, I mean, it's jurisdictions are a very important factor when it comes to picking assets. I think it's important to be places that are safe, but also price accordingly, because there are places where every asset will be unique depending to the degree of connections of each of those management teams relative to the government, relative to their permits and the community around them and so forth. So it's not so much jurisdiction, I guess, but it's very much linked to the project itself. We do, sometimes risk buying assets in places like Africa. We only have one investment in Africa. But that's mostly because of our views about the team and about what the level of excellence that they have when it comes to the likelihood of delivering a successful drilling program in that place, and then perhaps going even further. And so it's been a big work of really trying to systematize that part of the industry by understanding what drives a company to go from a project that hasn't really been drilled at all to peak speculation of there's something there and it needs to be valued much higher than what the market thinks. And so trying to figure out, valuations of companies in that stage of the industry has been fascinating. And I think there's so many inefficiencies there that will be, hopefully exploited over the years as more professionals become aware of those trends and metrics and different ways of calculating. It's almost like we're entering the Wild West of mining investing, where most folks have not entered in that manner, and really there are no real, I guess, guidelines of how to invest in the space. And so creating a whole new process to manage a portfolio in the space has been fascinating. And so we've been working really hard to use as much empirical analysis we can, as much data as we can, to drive our decisions and then be very geographically in focused, but also diversified, to not miss our steps on what we think it's going to look like in the next 5 to 10 years when it comes to the need and necessity of finding new discoveries.
Yeah, you actually took those words out of my mouth, the Wild West. I was thinking that, and I guess maybe that's why some people don't enter it, because they're concerned about maybe as you mentioned there, the risk factor. They're just not sure about how to analyze it. So, a few things you mentioned there. You mentioned analyzing a team, making sure they have a track record, that maybe they've done this before successfully. What other things would you say that maybe some, investors who normally analyze maybe traditional companies, sort of tech companies, or value companies, what should they be looking for when looking at these prospectors?
Likelihood of dilution in the future, of how much dilution you really need realistically to find what you need. The type of deposit you're looking at, grades, and that gives you a real expectation of what is the value of the mineral in the ground, level of recovery of those minerals. Also, I would say the possibility of M&A, I think that's been something that we always consider, and it's a huge part of our factor of investing or not. The scale of the business, how large it is, is it really a large enough business that can not only be built on itself, but also maybe built by somebody else, again, bringing in the expertise of another major company. I would say, the quality of the asset is something we spend a lot of time on, understanding the prior drilling or any sort of geological data that there is available about the project. Sometimes early stages are okay as long as they're priced the right way, understanding that every company, in the majority of times, unless you were in a crazy bull market in the gold cycle, which I think we could get to, but understanding that the risk is not owning low-grade large deposits, but instead high-quality assets that can be purchased in bear markets and bull markets that are desirable in any markets. I think that's the best way to really risk manage your portfolio over time. Taxation. How are you going to be taxed in different jurisdictions, depending on what the deposit's going to look like in the future and the profitability of that. Labor, do you have enough labor? Do you have a community backing that can actually help you to succeed in that space? Is the management team not only technically savvy, but market savvy to not only communicate back and forth with the market about the changes in the company over the history of receiving new data from lab results and other samples that they might use to educate the market about their own project, but also understanding when are times to be raising money and not be raising money. Those are all important factors. And so, some of them are subjective, some of them are more quantifiable, but always trying to, how do we quantify this? Sure, it's subjective. There's a lot of subjectiveness in this measurement, but how do we try to quantify as much as we can out of that? What are the odds of a three-bagger in a year from now, in this play? And usually just the final thing is or understanding is that a company will go from zero speculation to peak speculation in its normal cycle of that price appreciation. We'll get to about 20% of the value in the ground of that mineral. So once you figure out what the mineral will look like, or have a kind of an idea, you can model that out and see what the amount of minerals that are in the ground, and you can kind of have an estimate of the value of that. You take 20% of that value, that's kind of what the market cap of that company will reach at the peak of that speculation environment. Again, if you get to kind of a software environment like we had recently with software industries trading at 50, 60 times sales, kind of insanity market, sure, I mean, those things can be much more speculative. It can reach 50% of the value in the ground. Who knows? And again, that's assuming dilution as well, assuming capex and how much is it going to cost you to develop those things. And so there's a lot of factors that come into it. And we've certainly been doing a lot of work to understand what's the potential return of each of those assets that we have in our portfolio. And if they're down 10, 15, 20, 30%, how do we take advantage of those that have a higher potential of delivering a return in the future? So it's very quant driven what we're doing as well.
Yeah, it's really interesting. I guess, as you said, the goal is to make sure that even if, I guess, the value of the commodities go down, you still have a solid company that's going to potentially, hopefully, produce what you're looking for.
That's right. That's right.
Yeah, perfect. So, obviously the main, I guess, players when we think of commodities, obviously the US, there's Brazil, Australia. Are there any countries that you think are very underrated at the moment in terms of, the companies that you mentioned?
Oh, I like Brazil quite a lot. I think Brazil will benefit tremendously from this environment. It's a geopolitically neutral place that also has a very polarized politics right now, which I think it's a very good for the country, very different than any other South American place where the polarization happens between far left and center versus far left and far right. I think that polarization is actually a positive thing when it comes to forcing the population to rethink about their political views and gather information from both sides and be more centered when it comes to what should be the policies ahead. And I think that's certainly forcing Brazilians to be more considering both sides rather than just one side of the aisle, which used to be really centered to the left rather than the right. So I think that's very important. I think the countries that could benefit are Canada could benefit tremendously here. There's a lot of minerals to be explored in Canada. The Golden Triangle certainly is an area that we like quite a lot. Newfoundland was an area we've been investing over the years, but Golden Triangle is a place that we really focus on. Alaska is another area that we like quite a lot. Some parts of Europe, Finland is a place where we think that there's a lot of opportunities. Some parts of South America, like Bolivia, have tremendous opportunities there. They're very unique depending on the region of Bolivia, that could be more dangerous and harder to politically operate as well. But I think they all depend of their uniquenesses of their own projects and who is leading the teams when it comes to that and their connections and how are they able to couple with those issues. I think that there are some other countries, maybe Peru is a little bit more politically unstable, but there are a lot of opportunities there. So it depends on the project. You can find some opportunities. Mexico, we're quite concerned about Mexico, even though is extremely profitable when it comes to, I shouldn't say profitable, but extremely high quality assets that you can find in the country. Argentina, we're not touching anywhere close to Argentina right now. I think Argentina is headed towards Venezuela, unfortunately. That's not just because I'm Brazilian. I love people
the football rivalry.
But it's I just watch the trends of politics and I watch the trends of smart money. And it's been clear to me that those things don't happen at once, and they don't happen in 1 or 2 years. They take 10, 15 years to progress, unfortunately, not progress, but to go towards something along those lines. I think Argentina has been in that path for a while, with the currency devaluing and changes in political environment, always going more and more left. And at some point, you're seeing that polarized environment that will drive much more capital flying out of the country. And then you start seeing capital controls, and those are all strong signs of a country that is going downhill to me. And so I'm quite concerned about it. Like I said, Africa, China, Russia are places we do not invest. I don't think there are places. I think there are places in the world that are uninvestable. I don't invest in China. We have a few other investments in Australia. We like Australia quite a lot. There are a lot of interesting assets in Australia to own. But those are the main areas that I think we're focused on.
Do you have any sort of investments in Asia, or?
Not in particular right now that comes to my mind. I think that we've had investments in South Korea before. It looks interesting. There's some parts of Asia that are, I mean, I'm saying not right now. I mean, we may have 1 or 2 or 3, but they're not major investments. They're very small things. It's like Africa. We only have 1 investment in Africa, so it's not really a focus. Asia is very culturally, the differences are sometimes challenging to operate, unfortunately. But I'm sure there are great opportunities there. But sometimes politics gets in the middle. China certainly is a place that we do not invest at all. Japan, we're open. We certainly are very open to investing in Japan, and so South Korea as well. And but those are more politically easier places to do business with. And so that is quite important to us. Figuring out the politics. You may say, well, Bolivia is a terrible place to invest. They're actually pretty pro mining over the years too. So it's been much easier to operate in Bolivia than in almost any other place in Africa, and sometimes even in the US. So it really depends on the project. So I guess there are projects in Asia that could look interesting to us, but we're I guess we're focused more in some other jurisdictions.
I guess you have more than enough to analyze in all the other places you mentioned anyway, so you don't have to worry about it.
I mean, there's we got over 95 investments in the last 2 to 3 years in different areas of the world, and there are going to be a lot of I think consolidation that will probably happen in the industry that I think are important trends. But certainly, we've got investments really trying to focus mostly in Canada, US, and top jurisdictions. I think it's the best thing to do.
Yeah, we've found out like the last few months, I guess years, it's very important to focus on those types of countries. So Tavi, thank you so much for joining the podcast. And just my last question, what is one message that you'd like our listeners to take away from the interview?
Well, I think be open-minded to the changes that are happening in this new, not only monetary, but I would say inflationary regime, where it will create and set off a lot of new trends and new ways of investing. And be careful with the things that have worked in the last 5 to 10 years, because they may not work this time. And I'm talking about hedges. I'm talking about different metrics, quantitative metrics that worked in the past, like growth, because when cost of capital rises, it changes the way you should be analyzing companies and assets. And so the 60-40 portfolios, the risk parity strategies, and start thinking about the reallocation of assets or portfolios from things that are very unloved to things that are very crowded. Such as technology perhaps may not lead the way in the next 5 to 10 years. Some tangible assets and businesses that are related to those underlying assets may actually perform very well. So those are going to be important changes that will create changes in capital and labor trends, but also will set up a lot of good opportunities, I think, for investors that are paying attention to those macro trends in general.
It's definitely not going to be boring the next few years. We'll have a lot to talk about, I think. So,
That's right.
Tavi, thanks again. If anyone wanted to hear more about your work, where would the best places be?
I guess Twitter is where I'm mostly, share most of our views at Tavi Costa. And if you like to read more in-depth letters about my views, I guess you can go to crescat.net and you can look for investors letters. And we have research letters that come out every month or so. And they are, very long and or have a lot of charts and ideas of how we are really, creating our views and forming our opinions.
Perfect, Tavi. I'll put that all in the description below. So thank you so much for your time.
Thanks for having me.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.